Are accelerators really worth it? That's the question we're going to be answering in this video. And I'm going to give you the brutal truth. And it always starts with, it's complicated. I've had many founders ask me this question, and every circumstance is a little bit different, but we're going to confront the brutal honest truth in this video. And I've created this chart to help you understand and make decisions if you want to go into an accelerator yourself. Before we continue, my name is Ed Kang, 7-time founder with 2 X's. That's just fancy talk for saying I failed a bunch of times for your benefit, because I use videos like this in my entire YouTube channel to help early stage founders, especially if you're raising pre-seed or seed funding, avoid some of the catastrophic mistakes that I have made. Not to say you're not going to make mistakes, but I can help you avoid some of the damage, the heartache, the pain that goes with making these mistakes. I'm also the Chief Strategy Officer for Startups.com, an online on-demand accelerator, and that's what's going to make this conversation really interesting, because I'm just going to come clean and dish on the brutal truth of what it's like to be part of an accelerator program and how you can make those decisions. If you just happen to be joining us from Startups.com, thank you very much for participating in our community. I always appreciate seeing my YouTube subscribers show up at our community over there. And while you're here, you might as well just hit like, comment, and subscribe if you have not done so already. Let's jump in and determine whether accelerators are really worth it. Here we have the chart that I constructed as I really thought through how to help founders decide if accelerators are worth it. On the left-hand side, you are going to have reputation. Reputation can increase or decrease depending on what's going on with that accelerator, the perceptions, the trust that is built with founders out there. And on the bottom, you've got compensation. This is what and how you will pay to participate in these accelerator programs. First, you've got selling equity. This is where an accelerator comes and invests in you, and you're paying by equity, because we're not actually handing over cold hard cash, but you're selling equity, and that is the most expensive equity that you are ever going to have right in the beginning of stages. And that's the reason accelerators can make quite a bit of money if they do really well, because they're getting in at such an early stage. The second way is you'll pay cash plus equity. You'll pay a monthly membership fee or some type of general program fee, and you will pay equity. Either you'll sign over some of your company right now, or you will pay in future equity if there's some type of convertible or warrant. Then you get to paying cash. You are just paying. There's no equity trade. Maybe you're coming into a program, it's like a course, and you're just paying cold hard dollars to participate in the accelerator. And then finally, over on the far end, it's completely free. You pay nothing, no equity, absolutely free, gratis, no money down, no interest, no payments, forever. That's what founders tend to want, and rightfully so, because startups are strapped for cash in the beginning, especially if you're bootstrapping. Runway is important. So obviously, free accelerator is awesome. Now take a look at this curve that I've created. What'll happen is that as you move further along the compensation scale, you are going to go further down on the reputation scale. It's like an inverse exponential growth graph, a hockey stick that instead of going up and to the right is going down and to the right. Let me give you some examples of how this works. Over on the far left side, you've got Y Combinator, arguably the largest and most successful accelerator in the history of accelerators. Everybody wants to get into Y Combinator, everybody wants to be Y Combinator, everybody wants to invest with Y Combinator. And so the reputation is pretty high. Obviously, there are always detractors. There are going to be haters out there. But I hold Y Combinator in high esteem because I got some of the best advice that I've ever gotten trying to interview and get into Y Combinator. And I interviewed down there, and they gave me some great advice that allowed me to exit my startup without having to go through Y Combinator. So I appreciate all Y Combinator has done. Their courses online at Stanford and YouTube got me started in startups to begin with, and I continue to check in with them, and I just like knowing what they're doing to help me become a better advisor. And while many will rightfully ask, is Y Combinator worth it? Especially because they got this 2-tiered, you give up 7% for a certain amount of money. I think it's like $125,000 or $150,000. And the rest you get on something called Most Favorable Nation, which means their shares convert at the best price absolutely that they can get, depending on what you've done with other investors. That means Y Combinator can own a lot of the company, which they've done with Airbnb and Dropbox and Coinbase. Those are massive windfall investments, but you have to understand that Y Combinator is investing in hundreds of companies a year, and 90% of them fail, so one bet has to take care of the entire portfolio. And Y Combinator has done a great job in providing as many resources as possible for founder success. They give you the legal documents. They let you network with other founders, find co-founders, find investors, check with other founders on the reputation and reviews of those investors. There are many funds out there that only invest in Y Combinator companies. And on demo day, you've got this concentrated group of investors that come in just for you, and you will do deals on handshakes alone. That's the weight that Y Combinator can throw around. They don't want you to waste time with investors, and they make sure that the investors don't waste your time either. This is their reputation, and I think it's pretty high. If you have a chance to get in Y Combinator, absolutely go. But that's the issue when your reputation is that high and you're at the front of this long tail, then getting in, your chances are very, very slim because the amount of competition they have, well, it's like getting into Harvard 10x, an order of magnitude more difficult to get into Harvard or Stanford. The next closest one that I would say is Techstars. Techstars has a great reputation. I applied to Techstars a while ago. I didn't get in the first round, but what I appreciate about Techstars is they kept following up, and I was able to see all the different programs they have, and they're kind of divided all over the place. You don't go to San Francisco. You don't go to Silicon Valley for the Y Combinator batch. You go to these different accelerator hubs all across North America and around the world, and they're all divided into different verticals or industries. I've seen some great companies come out of Techstars. I've advised founders that have gone through Y Combinator and Techstars, and I would say the experience is pretty much the same. The terms are just a little bit different. I also appreciate what Techstars has always done to help the broader community. Very similar to Y Combinator, they're always trying to educate, and they partner with universities and created accelerators and incubators and different types of funding mechanisms for founders who are underserved, underrepresented, and underestimated. Techstars is really great at that. Y Combinator as well. So these two accelerator programs I definitely say are worth it if you can get in. Let's go all the way to the right-hand side where the compensation is absolutely free. The issue I have here is the quality incentive. I have seen founders go through other accelerators that are free and that are propped up by either government money or some type of grant, and the quality is questionable. Here's what I mean. When you've got advisors or you've got entrepreneurs in residence who are working for free and there's no upside, really, what is the incentive for them to work super hard and put their best foot forward? I'm not saying that you're going to get bad advice and those advisors are not quality. It's just the incentives don't necessarily line up. When you're talking about Y Combinator and every advisor that you get is a partner, participates in the portfolio, and if they do a great job and one of those becomes the next Airbnb, like Stripe eventually has to go public, it's not by the time of this recording, that's all an incentive for those advisors to do their best job possible and make sure the entire portfolio does well, because you never know how many diamonds in the rough that you have, as well as who's going to pop up. And if you can generally get the entire portfolio to be somewhat successful with those few outliers that are massive successes, overall that bodes well. They can go invest in other companies and start to pad their portfolio with the best chance for long-term wealth generation, all those fantastic exits. Y Combinator and Techstars have the track record to go the distance because they've been around. They've done so many cycles. But imagine you come to a free accelerator where they just pull some teachers and some advisors and some entrepreneurs from the local area. What incentive do they have? And what's the incentive to attract advisors with better quality? I know plenty of advisors and angel investors that give advice for free, but eventually that taps out because if there's no upside, then what are you going to do? That's the reason the reputation is lower when you get to the free side of the compensation spectrum. Not to say the quality will be lower, but the reputation is lower. There are hundreds of these programs spread out all around the world, and they're just not known well enough. Their reputation isn't enough for them to attract the best deal flow, the best advisors, and the best investors. You're going to kind of race to the bottom when it comes to these. Not to say you won't find a diamond in the rough. There are always great programs out there. And if you're a founder and that's all you can get into, it's worth it just to do that for a few reps, to get immersed in the startup culture, the industry, learn as much as you can, network with other founders. Wonderful for you if you can get into that, which the chances are much greater than getting into Y Combinator at Techstars. If you have a chance and that's what you got, go do it. Now let's move over to the pay money and give up equity. And I'm going to use this example, NewChip. NewChip is now out of business. They had a model where you paid something like $800 a month or $20,000. I can't remember what it was, depending on the membership tier that you were at or the program, really what the salesperson could get you in for. And they took out a warrant on your company, meaning that legally they were allowed to buy $250,000 of your stock at any point in time for a vesting period, something like 2 years or something like that. Other accelerators do a similar program where they take out a convertible like Y Combinator. They say, pay us some money, but we get a convertible on your company. We have the right to convert. Or they say we're going to invest in you and give you money for your equity, and then you're going to pay us back with money to participate in our program to cover our overhead costs. Some accelerators, like Founder Institute, my understanding is they make you incorporate and they take 2.5% of your company right off the top. And you're paying them to participate in their program, which means there's a waiting list, and they make you apply and they make you feel like, wow, this is really great that I've gotten in. But the problem is you're paying money at the same time and giving up that all-expensive equity. And here's what happened to New Chip. Completely shut down, went bankrupt. Not only did it go bankrupt, but the founders and the startups that were part of the New Chip portfolio had warrants out on them, like police warrants, just not from a criminal standpoint. What it meant was during the bankruptcy proceedings, they basically had New Chip on their cap table and they couldn't get out of it. The judge said, we need to protect the creditors and we need to liquidate all the assets possible. And New Chip ended up having an estimated $500 million in warrants. And the judge said, we need to liquidate them. And if we can get $150 million back to pay back everybody, then that's great. That means the founders were then stuck. They couldn't get out of their contract saying, New Chip's not giving me any value anymore. But they said no. The judge said, no, founder, you signed the piece of paper. It is a security and it is an asset. So then what happens with the next investor that comes along and you're looking at the company and you're like, okay, I'm going to invest $500,000. But hang on a sec. There's this note on the cap table that says New Chip can come in for $250,000. Not only that, it's not going to be New Chip, it's whatever entity, the investor that ends up buying that warrant. So the startup could end up having an investor, someone on their cap table, they have no clue who they are, they weren't allowed to vet them, they did not give permission. So the new investor comes along and says, wait a second, if I'm going to plunk in $250,000 and there's another investor that I do not know, the founder does not know, through some court proceeding, some fire sale, is going to come and walk in and be equal with me on the cap table, what do you think that investor is going to do? And I've read stories where founders have lost their companies. And this is the reason you have this big dip in the curve. Because when you're talking about $500 million in warrants that ends up being fire sale, that is not good for the reputation of accelerators across the board. Unless you are Y Combinator or Techstars, and you've got all these great investors, you've got deep pockets, that war chest, and you can hold on for the length it takes to make a startup get to the point where they go unicorn exit, which is 5 to 10 years, this is a really tough business. And unfortunately, it looks like a lucrative business, and a lot of founders are suffering. Taking a look at that curve and the stories that I just told, no wonder founders ask, are accelerators worth it? I see a lot of opinions out there. I read them on Reddit and read them on review sites. And founders are desperate to get access to investors, to grow, get that traction so they can't get that investment in. And they're given all these promises by these accelerators only to come up short time and time again. The issue is that 90% of startups fail. If an accelerator comes in and let's say moves the needle just by 10% and says, all right, we've gotten to the point where only 8 out of 10 startups fail. That is a gargantuan order of magnitude contribution to the startup ecosystem. But founders don't think that way. They're the ones that have to deal with the suffering and the failure of their startups. If you're in the 8 out of 10 startups that fail, even in a really great accelerator, even in Y Combinator, startups fail all the time after they've gotten $1 million seed investment. The pressure is extremely high with the investors and the venture capital that they take in. It's human nature to get cranky and salty about accelerators. And I'll just be straightforward. I deal with this on a regular basis. So many founders get mad at me. They place their anger on me, their disappointment on me, their shame on me. Emotions leak all over the place. And I say to them, wait a second, you're the one who has to take responsibility for this. I'm here helping you along the journey, but I feel the pain. I feel all of your pain if you're struggling with your startup. I get it. This is where I think that there's an opportunity in the startup ecosystem when it comes to accelerators. I think there's a gap between pay money and free, and that is a tiered system. With a tiered system, you can start to increase the reputation. And how do you do that? Accelerators have to start building trust. That is the number one thing. We have to rebuild trust because every new chip that goes out of business, every free accelerator that doesn't do their job, every advisor that gets in the game and doesn't realize how hard it is to work with startups and decides this isn't for me and basically leaves a founder totally in the dust, we lose trust as an industry. And what a tiered model will do is allow a founder to access the free resources and then start to pay for increasing quality. Here's where I'm going to insert myself into the picture. What I'm trying to do is offer free resources on YouTube and everywhere that I go. I dole out the advice, and I want my free stuff to be better than the stuff founders pay for in other accelerator programs. But I do have to make a living, which is the reason I work with startups.com, where members do pay. They don't pay a lot. They certainly pay less than they did at NewChip and some of these other programs, and we don't take any equity. I don't want to take equity. And there's a really good reason for this. Let me explain. Every startup in my mind has a better than 0% chance of making it. But the big players, such as the VCs and the Y Combinators and the Techstars, have to work in the top 1 to 2% of all startups because of the amount of money they're investing and the return on investment they need from their portfolio of companies. They're spending hundreds of millions of dollars investing in all these companies. Someone has to go unicorn and become a billion-dollar company to make a return on investment that will satisfy their partners and the entire model. I don't need to put that pressure on founders. If I take equity in a company, what happens is I'll only focus on the companies that I think are going to go unicorn, and I'm wrong all the time. I do not want to be driven by investors. I'd rather give everybody equal opportunity to get into some type of accelerator, equal opportunity to become a founder and have that better than 0% chance. It's tough enough as it is. Remember, 90% of startups will fail. I don't want to put any more friction than is required to get there. And if I can move the needle going from free to tiered, I've done my job in helping the ecosystem as a whole. Not to mention, I'm helping over 960, almost 1,000 founders right now. If some of them give me equity, what's going to happen? Other founders will start to suffer because I'm naturally going to move my resources and prioritize those, and I'll start to play favorites. And I might make a wrong bet, and that's not what I want to do. This is especially important for the underserved, underrepresented, and underestimated founders out there because I've experienced it on both sides of the table. But that's enough of a plug to work with me at startups.com. Take a look at this chart, do your homework and research, and make your own decision. Take responsibility for the money that you have, the equity that you currently have, and what type of accelerator program you might get into. And hopefully the entire industry as a whole works together to change that curve so that we're going up and to the right again, and there are more resources out there for founders. Hope this has been helpful. If you have an accelerator story yourself, or you have a contrarian opinion, or you just want to have discussion, leave a comment. I'm super happy just to hear from you. Your support has been amazing. I'll see you in the next video.